everyone. Welcome to our live every Thursday at 4 o'clock Pacific time. Today's topic is retirement account strategies you can still implement before you file your 2025 tax return. Of course, that's due on April 15th. Everyone remembers tax day. It's not a fun time, but you've still got opportunities to save and get money into a retirement account for 2025. Now, what we're going to be talking about is IRAs, 401ks, and other tax advantage accounts like HSAs. And what can I still implement by April 15th for 2025 tax purposes? This is a time when a lot of investors realize they still have opportunities to get money into accounts. They also have some cleanup of prior planning. I want to make sure we're all on the same page because this is important for two reasons. First, some of you are going to be chasing tax deductions. You want to make traditional contributions. Maybe you're trying to get Roth dollars and you want to add in some more tax-free growth in your life. That's great. We love Roth dollars. Either way, on this first point here is you're trying to make a strategic tax decision. Either give me tax deductions now or let me put money in an account that grows and comes out entirely tax-free later, like the Roth account, okay? That's reason number one why this is important. Reason number two, we're getting money in now and not passing up annual contribution amounts. The IRS only gives you a window of when you can put money into a retirement account, and they put a cap on how much you can do each year. So you've got to make sure you're filling in the buckets every year and maxing them out. And if you're someone sitting here of March of 2026 and you're like, I haven't put anything in for 2025, it's not too late. Most of the accounts that you can still put money in, you're going to have until April 15th of 2026 to get the $2025 in. So right now, March 2026, the key is knowing what can still be done now versus what needs to be done earlier in the year, because there are some things you did have to do by December 31st. All right, now let's talk about the next thing that is definitely on your mind. And I'm going to get to some specific examples here. We're going to get into some questions. So please be throwing those into the chat. I'm going to take priority for live questions, but I do have probably 15 on-point questions that have already came in on this topic. So thank for those that have been asking those and putting them in comments. But anybody that's live sitting here now, I'm going to give you guys priority, of course, once we get to questions. But what I want to do first is flesh out all the rules and what you need to know versus getting money in for 2025 and what's still possible. And I want to show you also on how this money stacks up, okay? Because one thing right now that's important is you're able to double up contributions because we have this window right now where you can still make 2025 contributions and you can make a 2026 contribution. Now, this is especially powerful with IRA strategies like the backdoor Roth, where you can simplify the contribution and the conversion by doing 2 years all at once. For example, I can put $7,000 in right now for 2025 and $7,500 in for 2026 for $14,500, and I can go and convert it immediately. Okay, that's awesome because it's one fell swoop. I'm doubling up on the contributions and I've got $14,500 in Roth contributions. If you're high income, you would have done the backdoor Roth to execute on that. If you got a spouse, your spouse could have done the same thing. Between the two of you, you would have 29 grand in Roth dollars by doing 2 accounts and making 2 simple contributions, but you're doubling up for the year. Okay, so I want to also cover updated contribution amounts. They have gone up for 2026. There's some good news there. But most of the accounts right now that we're going to be talking about and that most people have, IRAs, HSAs, even solo 401ks for you that are self-employed, we still have opportunities to get money in for 2025. Because the goal is not just to file your return or wait until the deadline when you're going to be scrambling. The goal is to make sure you've used every retirement account strategy still available to you before the window closes. All right, I want to make sure you understand these buckets of retirement and tax advantaged accounts because that's the fastest way you're going to get money in and you're going to get the returns compounding in your favor. All right, now let's go over IRAs here. IRAs and Roth IRAs. For 2025, you still have until April 15th to get the contribution in. Now, if you extend your tax return, this does not extend the window to get in IRA dollars. Okay. The deadline is April 15th. If you've already filed an extension on your personal return, the IRS doesn't care. They still want to see that contribution by April 15th. And every IRA custodian, including us at Directed IRA, we're going to hold your feet to the fire. You've got to get that in by April 15th. Now, HSAs are the same. It's April 15th, but there's a little provision here and a little thing you got to know, which is you must have had the high deductible plan still back in 2025. So that must have been by December 1st. So if you maybe move to a high deductible plan in 2026, that's great. You can do an HSA contribution for 2026. Remember, an HSA, in order to do a health savings account, you have to have a high deductible plan. So as long as you had one in 2025, you can still make a 2025 contribution. And your deadline is, again, April 15th, no extensions. All right. Now, for those of you who have a 401k, let's say you have a 401k and you're at a job, you have a career, you work for a company, there's no more contributions you can do. Okay. Your contributions had to have been done through your payroll back in December of 2025. Okay. It's just passed. We're not going to be able to get money into your 401k for 2025. But if you're self-employed, whether you're doing a SEP IRA or a solo 401k, you're going to have up until the tax return deadline for your company plus extensions. Now, this gets a little tricky for solo Ks, so I want to break down a couple of the quirky things for any of you that might be thinking of a solo K. And just in case you haven't heard of a solo 401k, this is the #1 retirement account for self-employed people. What a solo K is if I'm self-employed with no other employees, the IRS is like, great, do a 401k just for yourself. And since you're an employee in the business, because you're the one doing the work, you get to contribute like an employee and do employee contributions. But since you also own the business, you get to contribute as an employer. The nice thing for you is we're able to double up and do employee and employer contributions, which the total amount is $72,000. But it matters here on what I can do for 2025, whether I'm an S Corp or a sole proprietorship, okay? And these are the most common scenarios we're going to find. Most self-employed people, whether you're the doctor, the dentist, the realtor, the consultant, driving Uber, I don't care, okay? You're some self-employed person with no other employees. Most of them are going to be an S Corp or a sole proprietorship. So I want to at least cover those two scenarios. Let's say you're an S Corporation owner, okay? I have an S Corporation. We love S Corporations for self-employed people making more than $50K a year. And if you're an S Corporation owner, the good news is you can still set up a solo K for 2025, but you cannot do employee contributions. You can do employer contributions, but you cannot do employee contributions. So depending on what you made in the company, you can max out employer contributions. You can even do it up to the $70,000 total contribution limit for 2025. That's going to depend on the W-2 that you took. Okay. And when you put money into a solo K as an S Corp owner, your contribution as the employer, okay, is based off of 25% of the W-2. So, for example, let's say you're an S Corp owner. You have a $100,000 W-2. 25% of that means you can put in $25,000. All right, now that would be an employer contribution. Let's say you have made $200K on your W-2. You can put in $50K. Okay, so that's all I can do as an S Corp owner for 2025. Now, as a sole proprietor, you still can set up a brand new solo K. We're here in 2026, and you can do employee and employer contributions up until April 15th. Once April 15th passes, even if you extend your company return, which is your 1040 personal return, as a sole proprietor, this is going on Schedule C on your 1040. Let's say you extend that till October 15th. The IRS is like, great, we'll still let you set up a solo K. We'll still let you contribute to that, but only as an employer after April 15th. Okay. I know this may seem a little confusing. This is the tax code. This is what the government's going for. They're trying to make sure there's tax lawyers that still have a job. Okay. So I know it's freaking confusing, but just worry about your situation. Okay. Don't worry about anyone else. Okay. If you're an S Corp, just worry about what I said for S Corp. If you're a sole prop, just worry about what matters for a sole prop. And I will say, After your first year, once you set up the plan, you're just going to try to get the contributions in during the year and it doesn't matter. It's just this first year when you set it up and we're trying to go back and grab prior year contributions, it gets a little clunky. So right now, we can still do solo K contributions. We can still do traditional IRA, Roth IRA, backdoor Roth IRA, HSA contributions. If you got a 401k at work, you can't do 2025 contributions in your 401k at work. And another one that doesn't work is the mega backdoor Roth 401k. All right, this is whether you've got a solo K or whether you have a 401k at your work or place of employment. We love the mega backdoor Roth, but that does not work right now when we're sitting in 2026 if we're trying to do 2025 contributions. All right. In order to execute on the mega backdoor Roth strategy, you've got to do that in the tax year because a lot of that reporting and those contributions are going on your W-2, which needs to be filed in January. These are employee contributions that you must elect. Okay. Not to get too technical, and that definitely sounded technical, but just know mega backdoor Roth is off the table. Everything else is really fair game. And remember, solo K S corp owners, we can't do employee. Solo K for sole props, employees, you won't be able to do if you wait past April 15th. But right now, we got a lot of opportunity to put money away. Now, what I want to do is go over an example to illustrate all this. And I want to bring it all together. And what I want to show you is how when we stack all these different retirement account buckets together and we maximize multiple years of contributions, which we can do right now because I can do 2025 and I can do 2026. When we do that, it adds up to a lot of money we can put away. Because I know what some of you are thinking. Some of you here, oh, you can put $7,000 in a Roth IRA. And you're like, meh, that's not going to move the needle at all. But I want you to hear me out on this because if we run a real example here, I'm going to go over an example of a real estate agent I was talking to recently who was making good money. I'm going to show you how this adds up. And this real estate broker I was talking to was a little skeptical. She knew of Roth IRAs. She had heard of them. She thought they were cool. But she was like, I've never put money in any retirement account. I'm self-employed. Putting $7,500 in an account does not sound that great to me. I don't know what to do with that little amount of money. She's like, I want to put a lot more money away. I really want to start investing. I had a great year in 2025. I'm making good money. What do I do? Now, when we add it all up, and I get to do some quick examples with her options, this becomes compelling. So let's just walk through it here. All right, so let's first start with the Roth IRA. Now, in her example, she's high income, and anyone, and she was single, but anyone that makes more than $150K a year single, you can't just put money into a Roth IRA. So your annual contribution for 2025, $7,000 is what you can put into a Roth IRA for 2025. It went up to $7,500 for 2026. If you make more than $150K a year, you can't just put money in a Roth IRA. You have to do something called the backdoor Roth IRA, where you have a traditional IRA where you make the contribution and you convert it over to Roth. Now, I have other videos on the backdoor Roth IRA. I have articles on this. You can do the backdoor Roth IRA at Directed IRA. You can do it at Fidelity. It's a pretty well-known strategy for any high income earners. But I'm going to assume in this scenario, and just because the example of the person I had, they were over the income limits. So she would have had to do a backdoor Roth IRA. But if we did it for 2 years, that's $14,500 going in. All right. Because we got to do the 2025 contribution still until April 15th. And she can drop in the $7,500 for 2026. Now, she's an S corporation owner. She is an LLC taxed as an S corporation. She took a $120,000 W-2. All right. Now, she had other profit coming through the business, but her and her accountant decided I'm going to take a $120,000 W-2. Some accountants might have taken less on this. Some might have taken more. Whatever. It doesn't matter. Just say her W-2 was 120K. All right. Now, the W-2 is what we're going to use to calculate solo K contributions, which she can still do for 2025. But if you remember, she can only do employer contributions. S Corp owners that are still setting up a solo K right now for tax year 2025, you can't put in employee contributions. So in her example here for 2025, she can put in her employer contribution, which the calculation on that is 25% of whatever your W-2 is. For example, 120K W-2, 25% of that is $30,000. So for 2025, she can drop 30 grand in to this solo 401k. Now, we're already sitting in 2026. She's already made money in 2026. She can make her 2026 contribution right now as well. Now, let's say that she keeps that same, well, let's say that, frankly, let's say she just does the same W-2 of 120 grand. She can get effectively the full $72,000 into the solo K by just doing her employee contribution and after-tax contributions on the rest. She can do traditional contributions. We can get into that here, but the important thing what I'm saying here is for 2026, she can get the full max of 72 grand. So in her scenario, when I was analyzing it, it was like, all right, we can do a solo K, get your employer contribution still in for 2025, 30K in her example. And if you want to drop maximum money in right now to the solo K for your 2026 contribution, because she's already made good money this year, we can drop the 72,000 max into it right now. What does that mean? That means she can put $102,000 right now into a solo 401k. That's on top of the backdoor Roth IRA. So now she's sitting at $116,500 in tax advantage retirement account dollars. But we're not done yet. We can still layer in an HSA. All right. Now she's single, but she does have a kid. So that means she can do a family HSA plan. She has a high deductible plan in 2025. As long as she has that, she can make $8,550 is a 2025 contribution and $8,750 right now is a 2026 contribution. So on HSA dollars, she can do $17,300. Bottom line here is from backdoor Roth IRA to solo K to HSA, she's able to contribute $133,800. She could fund all of those contributions right now, opening the different accounts here, takes a solo K, takes an HSA, takes the backdoor Roth IRA, but all those funds can get contributed $133,800 in her example in tax advantage dollars. And most of that is 2025 contribution amounts. Now, each year here, because I had some doubling of the contributions there, each year here, if you think about it, she can do $72K a year in the solo K, $7,500 in the backdoor Roth, and can do $8,750 in the HSA. That means she's able to put about 90 grand a year of annual contributions in. And if you think of someone investing in retirement accounts, this is long-term wealth building we're talking about here. What's happening is you're putting $90,000 away every year in tax advantage funds. You think of the discipline on that, then investing that and growing it, right? We got to get to the other side of that here later. I'm just talking about getting money in, hitting the deadlines and maximizing contributions today. But you think of that over 10 years, we're talking 900,000, $1 million in just contributions that are in tax advantage accounts, growing, compounding. And if you're doing the Roth dollars here, which is what she would be doing, that's going to come out entirely tax-free. Now, let's say that she gets married or is married. She's single, but let's say that she later gets married. Or some of you that are married listening to this that could be in a similar boat. Well, we can double up those amounts. These retirement account contributions that we talked about there, the solo K, if your spouse can be added on payroll in your business, we're talking about adding another 72K that you could put in their solo K account. Also doing a Roth IRA or backdoor Roth IRA in there for their account. That's another 80K we can add in here. Now we're looking at maybe 160 grand of contributions annually between a married couple going into tax advantage accounts. All right. Now, some of you may have a 401k at work and the solo K is not on the map, but we're stacking your backdoor Roth IRA, maximizing your 401k at work where you're getting the match and getting out, layering on an HSA, right? We got all these tax advantage buckets going in where you're at least able to put away 50K a year annually in different tax advantage accounts. And I should say at least 40K. I think you'd be able to combo up, even if you're working for a company and don't have the option of the solo 401k. All right. So that's the power of hitting these deadlines, is layering in the buckets, doubling up on contributions right now for 2025 and 2026, and focusing on getting money in tax advantaged accounts. And the reason I like retirement accounts and the reason a lot of savvy investors and people who are getting an advantage over others are using retirement accounts is when you make money, when we're now out investing this, okay? When this the client is out that the example I gave, when she's out investing that 133 grand, and let's say she gets a 10% return of $13,000 back into her account, that 13 grand is 100% back in the account. Nothing's coming off the top eating into the return going to the IRS. Nothing's going to the state, right? That's the benefit of retirement account, and the incentive the government has given us is you get the money in, you get to grow it and compound it. You don't have to pay us. And that ability to compound every penny of returns is massive when you look at investing over 10, 20, or 30 years, which is what most people are doing with their retirement accounts. So getting the money in is critical. The advantage of the tax advantage account works in your favor, and you get a leg up on everyone else because you're investing smarter. So, all right, now I want to see if we have any questions that are live right now. I definitely have a number of questions lined up here that I love to hit. I was telling the team here, the questions that have came in are so good on these topics. But what do we got live, Jordan? You got anybody live?
Everyone's shy so far.
Okay.
So we got quite a few on, but everyone's shy. So let's hit some prepared questions.
Okay. All right. Maybe I put everyone to sleep. I don't know, but Okay. This question came in from Ramiro Sepulveda 2306, who also listens to the podcast, says, love the podcast. Great information. If I'm already maxing out my 401k at my job, and I'm also maxing out my Roth IRA, can I still invest in an HSA or not? Yes. All right. This stacking in the example I just went through, you can have a 401k at work. You can have a solo 401k in a business or a side hustle or other main hustle you might have. You can do a backdoor Roth IRA, and you can do a health savings account. So absolutely, that's possible. The one thing I would question here is just on your Roth IRA is making sure you may need to be doing a backdoor Roth IRA. If you're someone that's maxing out your 401k at work, you're probably a high income earner, which means you probably need to do a backdoor Roth IRA. I don't know if that's what you're doing, but in any event, yes, HSA, Roth IRA, 401k, you can use all of those. And if you have a spouse, they can be doing a Roth IRA. You do the family HSA, so you don't have one HSA between the two of you, so they wouldn't do their own HSA. But of course, they could be doing their own 401k. All right, next question, though, that we had came in from Elahe 190. Said they asked, if I open my solo 401k in March of 2026 as an independent contractor with a 1099, I'm presuming a sole proprietor. By the way, you asked the question. Yes, can I contribute to both employee and the employer portion of the solo K for 2025? Yes, you can, as long as you do it by April 15th. Do not wait. What this means, LA 190, is you got to get moving now, okay? We're in March. April 15th is going to be right around the corner. Most professionals, accountants, tax lawyers, retirement account providers get busy on April 15th. So you want to get moving on this. But the good news is, because it sounds like you're a sole proprietor because you talk about being an independent contractor on 1099. I presume you're filing your business income on Schedule C of your 1040. You can still set up the solo K and make employee and employer contributions for 2025. If you're an S Corp owner, okay, we're only going to be able to do the employer contribution for 2025. Now, one other thing for any of you setting up a solo K right now, or that may be doing, or that already have a solo K, is there was a new tax credit of $1,500 by doing an automatic contribution arrangement in your 401k plan, which is something you can create in your own solo K. You can say, I'll create an automatic contribution arrangement in my own solo K. The government is giving you a $1,500 tax credit to adopt that for yourself, which you can revoke at any time, by the way. And the way you get it is it's $500 per year over 3 years for a total $1,500 credit. This is a tax credit that will flow through to you personally. All right, so this is big. This is not just a tax deduction. This is a tax credit of up to $1,500. We do have some articles and other resources on that credit. That's something relatively new in the solo case space that came out under recent retirement legislation known as Secure 2.0. All right, I'm just going to tell Jordan to interrupt me. And guys, if you got questions, I'm going to prioritize your questions. I got like 9 other questions still to hit. So we're going to hit these other questions that came in advance or that were comments on prior shows. So don't be shy. All right, next question was from Everywhere Is Mine. They asked, so I'm in my 60s, still working. Can I move some of my 401k to my IRA, or do I have to move all of it at once when I retire? I'd like to start getting it started, making some money in my control and not the company's. All right, now when you have a 401k with an employer where you still work, you are able to do something called an in-service rollover if you are at retirement age of 59 and a half or older, and some plans will state it at 55. So in your example here, you're in your 60s, you can, even though you're still working at that employer, roll that amount out, the whole amount or a partial amount. The IRS doesn't care. And that can go right to an IRA. And I like what you're saying here. You have more control and more investment options when you roll it out to an IRA. A lot of 401k plans are going to have a menu or a lineup of mutual funds or target date funds you can invest into. And that's just because the provider they picked. And frankly, it's kind of the box that the 401k industry gets put into. But once your money's out of that 401k and into an IRA, you can now self-direct it. You have greater control of your investments, and you have more control, frankly, of the fees. The average 401k, by the way, in America is charged 1.5%. If you got a $100,000 account, you're paying $1,500. You don't see it because you're getting nickel and dimed everywhere. It's not like you're getting a bill for it or an invoice, but you're getting nickel and dimed for it. So you also, in many instances, can be saving money on fees in addition to getting better investment options. All right, next question came in from Dan Rary. Dan asked, I'm self-employed, no employees, just me. Why should I use a solo K instead of a SEP IRA? I'm currently contributing to a SEP IRA, but I'm wondering why it wasn't mentioned at all in this video when discussing self-employed people. All right. Now, Dan probably watched a video where I talk about solo Ks because I love solo Ks, and I said nothing about SEP IRAs. I gave zero love to SEP IRAs. There's a reason, Dan. SEP IRA is a little easier, but a solo K is better. Here's why. In both a SEP IRA and a solo 401k, you can put 25% of whatever you make into it as effectively an employer contribution. All right, so let's say you make 100 grand. Let's say you're an S Corp owner, you take a W-2 for $100,000. Many small business owners, the ones that are tax smart, are S Corp owners. So you got a $100,000 W-2. You can put in 25% of what you make off that W-2 into your SEP IRA, $25,000. You can also put in 25% of that W-2 into a solo K. So they sound kind of the same, right? But in a solo K, on top of that, you can do an employee contribution of $23,000 for 2025 or $24,500 for 2026. So in other words, in 2026, I can be putting in off a $100,000 W-2, only $25,000 into a SEP IRA, but I can do $25,000 plus $24,500 into, let me just confirm here, the 401k at 24.5, I was right. Okay, I can do 25,000 plus the 24.5 into a solo K, which means I can put in 49,500 into the solo K off a $100,000 W-2. I can only do 25K into a SEP IRA. I can put in twice as much into a solo 401k. Now, because most small business owners or self-employed people with no other employees, many of them use an S Corp. You might be making $300,000 a year, but you're only taking a W-2 of 100K out of your S Corp because you're trying to keep your self-employment tax down. That's why you're using an S Corp. You want a smaller W-2. And because of that tax planning strategy of minimizing the W-2, we like the solo K comboed up with it because I can get way more money in off a smaller W-2 than I can a SEP IRA. Now, if you're like, Matt, I had 100K on my W-2. I was only trying to get in 10 or 20 grand. Great. There's no difference. In fact, I'd probably say use the SEP IRA because it's easier and it's cheaper. But if you're someone that's trying to maximize contributions and you're looking over 10 or 20 years of how do I get money in and maximize the dollars being invested, I like the solo 401k over the SEP IRA. Okay. That got a little lengthy, Dan, sorry, but hopefully that was helpful. All right, Jordan, you cut in here. Okay.
Everyone's on spring break, apparently.
I guess so.
They're not thinking about tax
Okay.
deadline.
Okay. All right. That's all
Yeah.
good. That's all good. All right. The next question came in from S. Stoney 1. Says, I'm over the income limit for a Roth IRA. If I do a backdoor Roth IRA now before April 15th for 2025, can I still make a 2025 contribution, or do I have to have the account opened last year? Great question. Oh, shit. Sorry, I did the wrong one. Okay, let me come back on that. And sorry, did I just get, explicit rated on this live? Dang it. Okay. All right. Yeah. Okay. S. Stoney 1 asked, I'm over the income limit for a Roth IRA. If I do a backdoor Roth now before April 15th for 2025, does the conversion still count for 2025 or does it fall on the 2026 tax year? Great question. The conversion is actually going to be on your 2026 return. But what happens is, let's say that in March of 2026, you do a backdoor Roth IRA. You put money in the traditional $7,000 for 2025 contribution amounts, and you convert it over to Roth. When you do that conversion, you will get a 1099-R from us or any retirement account provider when you do that conversion. But when you get that 1099-R, you're going to put it on your return, in this case, your 2026 return, and you're going to say, this was non-deductible traditional dollars I did not take a deduction for. Therefore, the conversion is not taxable. So you will click on the 1040, not taxable. Okay. And there's a little schedule that comes back on this 8606 where you do this. So the short of it is technically it's a 2026 1099-R, even though it's a 2025 contribution, because the conversion and that 1099-R triggers in the year you actually do the conversion. Okay. Great question, S. Stoney. A little technical, but that's the mechanics you'll see so you're prepared when you're doing your actual tax return. All right, next question. This is from Matt Tower. Asked, I'm self-employed and just learning about solo 401ks. If I set one up now before April 15th, can I still make a 2025 contribution? Or did I need to have the account open last year? All right, you can still set up the solo 401k now for 2025. But remember, depending on whether you're an S Corp or a sole proprietorship, that depends on whether you can still make an employee or employer contribution for 2025. So, Matt, if you are a sole prop, you can do employee and employer still until April 15th. If you are an S corporation owner, you're only going to be able to do the employer contribution for 2025. All right, next question came in from Dan, our business owner. Dan, our business owner said, I run my business as an S Corp and take a salary. If I want to maximize a solo 401k contribution for 2025, does that come from my W-2 salary or from my S Corp profit? All right, great question. This comes from your W-2 salary. All right, many S Corp owners, when you have an S corporation, you pay yourself a salary, which you get a W-2, and the rest of the money comes through as profit or dividend. The reason S corporation owners do that is when I'm making money in an S Corp, let's say I made 300 grand. And when I get that 300 grand, I have to pay self-employment tax on it. But if I can send 100,000 of that 300 grand in a W-2, I will pay self-employment tax. But the other 200K is going to come through to me and exempt from self-employment tax. That's your Medicare and Social Security. You're going to phase out on Social Security at a little over 160, 180 grand or so. But you still have Medicare after that. So most people use an S corporation because they're trying to minimize paying into Medicare and Social Security. All right. And profit income out of an S corp is exempt from that. So when you're looking at how much to contribute, we have to focus on the W-2. And I know a lot of people are like, well, Matt, that sucks because I'd rather look at I made 300K rather than I made 100K. I could put more in if I'm going off 100K. But as I gave an example earlier, even on 100K W2, you're putting 49,500 into a solo K as an annual contribution. So we're going to be looking at your W2. Your S Corp profit, frankly, is immaterial to what you can put into your solo 401K. All right, Jessica Outdoors asked, if someone qualifies for an HSA but hasn't contributed yet, can they still put money in the HSA before April 15th and have it count for the 2025 tax return? Yes, they can. You just must have had a high deductible plan back in 2025, and it must have been before December 1st. As long as you did, you can still make your HSA contribution before April 15th. Just make sure that you get the money in before April 15th. Even if you extend your return, that does not extend the time to get the contribution in. So just make sure you get it in before April 15th. But the good news is you're still good. You can still make a 2025 contribution.
We got a live question.
Oh, we got a live
We're ready.
question.
Yep.
All right.
There we go.
Pause.
All right.
Mike and Lisa from Texas have to be on hold here. All right.
Jocelyn 12.
All right.
The live question. If I made Roth IRA contributions last year and I realized I fall out of the income limits, is there a way to fix that mistake? What is the best way to plan for this if my income fluctuates? And then they added a comment. I have an SD IRA and these funds are already invested.
Okay. All right. What you can do is you can recharacterize the contribution before you file your tax return before April 15th. So it's a good time to do it right now. And we have to do this every year for a handful of clients. So you can recharacterize the contribution. What we would do is we would recharacterize it as traditional, and then we would immediately come back and convert it back to Roth. So we're basically going to try and fix this with a backdoor Roth IRA. Now, you're going to have some tax on the earnings and growth, if any, from this little window of when you put the money in, if the money is already invested. So it can be a little complicated here. What I would say is anyone that's in the bubble area where you're like, I'm single and I'm going to make around 150K, or we're married and we're going to make around 236,000. If you think you're going to be anywhere close to that number by the end of the year, just do the backdoor Roth IRA. Just do the backdoor Roth. You could do the backdoor Roth IRA if you make 10 grand a year. Okay. There's not like there's an income where you can start doing it. You can do it at any level. And that way, if you do the backdoor Roth IRA and you hit these limits, it doesn't matter. You don't have to go back and fix this later. So I would do the backdoor Roth IRA for anyone that thinks they're going to be around these income limits. So, but for Jocelyn, you're going to have some work to do. Our team has had to do this for clients over the years. So you can either just recharacterize and go to traditional and call it traditional. But if you want to get it back to Roth, we're going to have to do kind of a fix it backdoor Roth IRA, which is possible. We'll just have to pay tax on the growth if there was any in that window of time since the money was invested. Okay. All right, let's get back to Mike and Lisa from Texas and their question. Mike must have asked this, says, my wife and I both work and file jointly. If we contribute to IRAs before April 15th and we are allowed the full are we allowed the full contribution amount, or is there a combined household limit? Great question. You can both make the annual contribution, $7,000 a piece for 2025. Plus, if you're over age 50, by the way, you also each get an extra $1,000, where you can be doing $8,000 a year. Now, let's say, I don't know in your situation, Mike and Lisa, but let's say, Mike, that Lisa doesn't work. And maybe you have kids. Lisa takes care of the family, so she's working at home, frankly, with the kids, but she doesn't have a job or her own earned income. Well, you can attribute income from one spouse to another. So when you make contributions to an IRA, a Roth IRA or a traditional IRA, you must have earned income. But you can attribute income from one spouse to another. What that means is, in every instance, for a married couple where at least one of them is working, you could be doubling up on the contributions and be doing $14,000 a year, $7,000 in each of your IRAs. You'll both have separate accounts. And if you're 50 or older, you'll be doing $8,000 a year. So Mike and Lisa, what you could be doing is $7,000 for 2025 each for 14, plus $7,500 for 2026 for 15 grand for a total of $29,000 that you're putting in right now into a Roth IRA, or if you're over the income limits, a backdoor Roth IRA, in one fell swoop here. Because we're in this window again of we're sitting in March of 2026 where we can do the 2025 contributions. We can also throw in the 2026 contributions at the same time. All right, another live question. All right.
Yes. From JJ Blockchain, this is written in a way that we may need more information, but let's try. In your opinion, what is the minimum amount of W-2 earnings needed to report to claim max?
To max out, okay. Well, it depends on what we're trying to max out here. Obviously,
Right.
an IRA, you just need 7
Right.
grand. You just have to have an earned income of 7 grand for 2026, 7,500. I assume this is about the solo K.
Yeah.
So there's a couple ways you can max out a solo 401k. All right. One way you could max out a solo 401k. Let's go over an example. Let's just take that 100K W2 person. Okay. Let's see at 100K W2. You're doing a solo K. Now, the first way we put money in is for 2026. I'm just going to run 2026 numbers here. All right. I can put in 24,500 for an employee contribution for 2026. Okay. As long as I made 24,500 and I did 100K in my example here, I can put in 24,500. Okay. That's just dollar for dollar. The next thing is I can put an employer contribution, 25% of that of 100K, which is 25,000. I'm just keeping my own notes here. Maybe I'll have to put this on the iPad, but that's going to get me to 49,500. Okay. And I've given that already in the prior examples. But you're like, well, Matt, I want to get the difference here to 72 grand, right? I've still got 22,500 left to get to the maximum amount I can put in a solo K. How do I get there? Easy. After tax contribution. Our solo K plans that we do at Directed IRA, or even our lawyers at KQS Lawyers, whatever we're doing, our plan documents are pre-approved by the IRS. You can self-direct them. You can do brokerage. You can do a real estate deal, invest in private funds or crypto or precious metals, whatever you want. But our plan document allows for after-tax contributions. So the rest of the amount that I would need to do there, 22,500, you can just do in after-tax contributions. And what I've seen some clients do is they just skip the employer contribution of 25K and they just do, frankly, 27,500 in after-tax contributions. And they have the 24,500 in regular employee contributions. They do, let's say they do 24.5 in employee, and then they do 47.5, in after-tax. All right. Now, if I lost anyone there, that's okay. You can get a consult with one of the attorneys at KQS Lawyers. Anyone trying to max out contributions, nail their W-2 amount, figure out how to do after tax and do with what's called the mega backdoor Roth. That's what this is that I'm going over right now. You probably want to talk to your accountant or CPA. Hopefully you have one that knows it. And if you don't, our attorney at KQS Lawyers can walk you through it, and we can even get the solo case set up properly for you as well. So bottom line, by using the mega backdoor strategy and doing after-tax contributions, you could do it on as low as $100,000 W-2. Otherwise, the old school method, and sorry to go long here, but would say, all right, I can put in 24.5 of employee contributions, but I've still got 49,500 left. How much of a W-2 do I need for that to be 25? I need that's 25%. What is the amount? 190. Okay. So you need $190,000 W-2, which would be 25% of that. If Jared did his math right here.
I believe in him. Okay.
It looks right. That's right. Close. Okay. 25% of that would be 49,500. Okay. Is that right? 47,500. That is right. Okay. All right. Okay. Sorry. I sometimes you need a little help here, guys. Okay. All right. So off 190,000 W-2, you could do the old school method. Just do your employee contribution of 24.5. 25% of 190 is going to be 47.5. Now we're at the 72,000 total. Or if you want to be a little more strategic, keep your W-2 low, for Medicare and Social Security tax purposes and minimizing that tax, go the after tax method. Okay. Again, make sure you have an accountant, tax advisor that knows what the hell they're doing, because this is not like something you're going to do in TurboTax. Okay, maybe, but you better know what the hell you're doing. And of course, I again reference the attorneys at KQS Lawyers. That's my law firm. They can certainly help with that if you need help on strategizing for that. We have articles, other resources. I got videos on the mega backdoor Roth, but it does get a little particular in your situation. Okay.
All right. We have at TSC1. If there are Roth deferrals in my traditional 401k, is there an impact to contributing to my Roth IRA?
Okay. The question was, if there are Roth deferrals in my traditional 401k, is there an impact to contributing to my Roth IRA? I don't understand that. If there are Roth deferrals in my traditional 401k, so no, really, I don't see an issue here. When you say Roth deferrals, I think you mean Roth dollars in your 401k. So you can have traditional 401k dollars, Roth 401k dollars, whatever you're doing in your 401k, you can still have a Roth IRA. Now, there is a rule that says if you have a 401k at work, you can only contribute to a traditional Roth IRA under these income limits. But the way around that is do a backdoor Roth IRA. So whenever I see someone that is contributing to a work 401k and they're high income, whether they're maxing that out or not, whether they're over the 150k single, or actually 150k single, 236k married, that's when you start phasing out and can't do regular Roth contributions. I'm going to just say, just do a backdoor Roth IRA. So in your scenario, you may need to do the backdoor Roth IRA. That would be the safe route because you have a 401k at work, you are contributing to that. And so your ability to contribute to, frankly, a traditional or Roth IRA and a traditional IRA where you get a deduction gets limited, but you can still do the backdoor Roth IRA because the backdoor Roth IRA is like this double loophole. Okay. What I mean by that is you're putting money into a traditional IRA, but it's called a non-deductible contribution. And non-deductible contributions don't have income limits, don't have phase-out limits. It doesn't matter whether you have a 401k at work or not, okay? It's like this clean thing. Anybody can freaking do it, all right? Even if you're Warren Buffett and he's maxing out the, Berkshire Hathaway 401k, all right? He can still do a non-deductible traditional contribution. He can also convert that to Roth because there's no income restriction on Roth, and voila, you have a backdoor Roth IRA. So the loophole is two things. It's getting around the income and deduction limit for those of you that contribute to a 401k or that are over the Roth contribution limits. And then it's also using this other loophole, which is there's no income limits on Roth conversions. By the way, there used to be. That was 10 plus years ago, but that restriction was removed. So we can convert those dollars over to Roth. And this is, I have to say, like the backdoor Roth IRA is probably the most commonly used tax loophole in the entire tax code. And it's used by everyday strategic American savers. It is not a billionaire strategy, okay? It's an everyday American person who's making good money, you're upper income, and you're trying to maximize tax advantage dollars and be strategic. So it's definitely one you should have on your list.
All right. We've got Rip Urfer 08. Sorry, that's kind of a tough one. When does a whole life insurance policy make sense to use? Purchase it to get a loan on it. Plan is to get funded quickly without triggering MEC.
Okay. I'll just say I know my lanes to stay into. I'm not a whole life insurance expert. I'm more a retirement account guy. So I'm just going to be honest and say, I don't know. I've seen good and bad on the whole life insurance. Frankly, we see people what they call mech out, which is what he's talking about, the MEC, and it fail, or we see people set up those plans and not contribute to them regularly, and they fail. I've also seen people be very strategic about them and consistent about getting money in these whole insurance plans and loaning the money out. But I don't know the nuances of it. That I'm not your guy for that question. So.
It's all right.
That's a punt.
Yeah.
That's a punt.
It's okay to punt sometimes.
Yeah.
Okay, this one is from, I'm not even going to try this one really. Lakshmir, you know what? It's a long name.
That's
So,
just,
but if I have to, it's a great question. If I have to do a backdoor Roth starting this year, should I do the conversion only once, or can I do 7,500 for 2026 as I have more savings available for the rest of the year?
ooh, okay, good question. It doesn't matter. Don't worry about it. Because when you do a conversion on the backdoor Roth, it's not taxable. See, the backdoor Roth, see, when you put money in a Roth IRA, let's say you put 7,500 bucks in a Roth IRA, you don't get a tax deduction, right? And so when you're doing the backdoor Roth IRA, it's a two-step process. Again, you're going to put money in a traditional IRA, but you're going to classify it on your 1040 as a non-deductible contribution. So let's say you're doing it for 2025 and 2026 right now. So on your 2025 return, you're doing 7,000 bucks. What that looks like on your 2025 return is it's going to be classified as non-deductible, meaning I did not take a deduction. When you convert a non-deductible contribution, there's no tax on it because you never took a deduction. So the IRS is like, we don't need to tax that. You never took a deduction. So as a result of that, you'll get the 1099-R for the conversion of 7,000 bucks, but it's not taxable. So it's not going to affect your tax situation. So you don't need to be strategic about what year to push it to or not. Frankly, it doesn't matter.
All right. We have another question. YTE being another Wealth Office
Now
Hours
everybody's
regular.
asking their questions.
I know.
Now everybody's got questions. We got 5 minutes left. All right.
My parents have a Roth IRA. Is it permitted if my Roth partner with my parents Roth to, if my Roth partners with my parents Roth to buy a rental? When rent comes in, parents Roth takes all rents and my Roth gets percentage of ownership every year.
Okay. Love this. This is a self-directed question here where your retirement account can own rental real estate. Okay. You have a Roth IRA, it can invest in an LLC, it could buy that owns real estate, it could buy real estate directly. It could lend on real estate. That's what we do at our company, directed IRA, if you didn't know that. So this is that question's around. Now, Roth IRAs only get credit for investing. And this question is you're trying to get credit for your Roth IRA for it doing nothing, frankly. What your Roth IRA only gets credit for is investing the dollars it put in. So I'm okay with your Roth IRA partnering with your parents' Roth IRA to go make an investment. For example, let's say there's a rental property for $300,000 that you want to buy. Your parents' Roth IRA is going to put in 150 grand. Let's say it's your mom's IRA. And let's say your IRA is going to put in 150 grand. We will require you actually to put each of those IRAs that will invest into an LLC, and the LLC is going to own the property. Your mom's Roth IRA that put in 150 grand will own 50% of the LLC. Your Roth IRA that put in 150 grand will own 50% of the LLC. We always have to break up the ownership in an asset based on the dollars invested. There's a lot more to this here because you're also considered prohibited parties or disqualified persons. You can still co-invest into the same asset, or we break up the ownership in the asset based on the dollars invested, but you can't buy and sell between each other. So you got to be a little careful here. I did write a book called The Self-Directed IRA Handbook. There's a few chapters on this stuff alone about how you structure this and what you can and can't do. But I just want to give a specific answer to this question, which is can't do it how you're planning, but it is possible to partner your Roth with your parents' Roth to go buy a piece of investment real estate. And if you're someone here watching this, it's like, what the hell is this guy talking about? This is totally possible. Just like your Roth IRA can buy a stock and get dividends, and when you sell it and it appreciates in value, there's no tax when it goes back to your Roth IRA. You can do the same thing with real estate. Your Roth IRA, traditional IRA, whatever retirement account, it can own a piece of real estate. It collects the rental income. When you sell the property, the gain goes back to the retirement account, no tax, right? And if you're someone that believes in real estate and knows real estate, that means you can invest in what you know, and hopefully you'll get a better return by investing in what you know and an asset you believe in versus investing in the stock market or something you may not know or may not have a perspective of being where to put your dollars. So these are called self-directed IRAs. Your IRA can own real estate. It can invest in a private fund, a startup, a small business. Your IRA doesn't have to be invested in the public stock market. It can. That's great for a lot of people. But frankly, we have a lot of entrepreneurial clients, real estate investors, people who like small business or who are entrepreneurial. They want to invest in assets they know and believe in, or at least take a portion of their retirement account dollars to invest in those assets. That's what you can do. with a self-directed IRA. And I have a video on what's a self-directed IRA. We have a whole resource center with tons of resources to learn more on that.
We catch one more?
Yeah, let's grab one more.
All right. This one is from Michael Hayes, agent. I have a pension and I will have an estimated maxed out Social Security, maxed out 401k, Roth, HSA, and I have a brokerage account. What should I be focusing on? Am I missing anything?
Okay. All right. Says, I have a pension. I have sorry, I'm trying to read on the board here. I have a maxed out
Social Security.
Maxed out my 401k, my Roth, my HSA. I have a brokerage account. There's obviously no cap on that. What else should I be investing in? Am I missing anything? Okay. Well, I'd just say if you have a spouse, you doubling up on contributions for a spouse. Do you have kids? If you have a business, are you putting money into a kids Roth IRA? Okay, like my kids worked in my law firm and they would come and clean the office every Saturday. Like every Saturday for a few years, I would go to the office and work in the mornings and my two oldest daughters would clean the office. I paid them for that. I expensed it in my business. I took a deduction for it, right? Because I would have had to pay a cleaning company to do it, but I didn't give them the money. I put it in their bank account. They were 13, 14 at this time, 13 and 15. And then I put it into Roth IRAs for them. All right. And those contributions to the Roth IRA is effectively what we call a kid's Roth IRA. So if your kid has earned income, maybe they got a summer job that they're actually earning the money and spending it all on dumb stuff. Maybe they're working in your business. If they have any earned income that you can justify, they're working on your rental property, pay them, give them some earned income. That earned income allows them to put money into a kid's Roth IRA. So that'd be another option, because really what's happening now is you've gone through a number of order of things where you're maximizing a lot of the dollars for yourself. And if you've been doing what you're talking about already for like 10 years, you have $1 million or more already in tax advantage accounts for you. And you invest that for another 10 years and keep doing what you're doing, we're talking $3 or $4 million, okay? Just from the additional contributions and growth you're going to have, your money really starts compounding and working in your favor. So what should you be doing next? How am I helping my kids? What does my spouse's account look like? Maybe I start to look at real estate, rental real estate outside of my account. Maybe I look at other investments and alternative assets I can invest in. Maybe I'll actually look at some of this low interest debt I have in my life. Obviously, you've probably paid off your credit cards by now, and any high interest debt is gone out of your life. But do you have some low interest debt hanging around? A car loan at 7 or 8%? Maybe you've got a higher interest mortgage you could pay down. I'm starting to think at this point, maybe paying down some of that middle interest debt. If you've got a mortgage at 2.5%, let that sucker ride. Do not pay that off, okay? But what I think is happening now is you've probably become financially savvy. You're a little more sophisticated than someone starting out. You've got a lot of other investment options to start looking at. But I also like thinking about your family and other people where you can get tax advantage accounts going for them and teaching them how to learn to grow and build wealth as well. And wouldn't it have been awesome if your parents would have done that for you? Done a Roth IRA for you? Like my parents did that for me when I was 15.
Yeah, game over.
Yeah, I mean, that would have been freaking awesome, you know? I wouldn't have to be here doing Wealth Office Hours live. No, I'm just kidding. I still would.
I do it for the love of the game.
Yeah, for the love of the game, yeah. No, seriously, I'd still do it anyways. Yeah. I'd be telling you this story about how my parents did a Roth IRA for me and how cool it was. So, but there's still other things. I just throw those out there for you to think about. But of course, there's only so much you can put in tax advantage accounts. But I think for people that are making less than $1 million a year, you should be focusing on all of that first, even less than 500K. A lot of people are making 500K and they're still able to maximize every retirement account option and bucket available. If you exceeded that, great. Let's look at other rental real estate. Maybe you're investing in businesses, maybe other alternative assets. Maybe you're just dropping money into a brokerage account if you don't know what else to do. That's totally fine. Okay, keep investing and growing and building that wealth. The trick is getting the money deployed, being consistent about it, and then having the time to go back and look and being more strategic. But what you should not do is do not fall into the trap of chasing the shiny object or chasing some ridiculous altcoin or startup that you don't even understand what the hell this software does or what this AI technology actually is. All right, invest in what you know. Let's be pragmatic. Let's be practical about this. And we know that as our investment dollars are invested, they compound and grow over time. And time is your greatest ally as you're growing and building wealth. So, great question to end on. We'll just end it there.
Yep.
Okay. All right. I was looking at Jordan to see if we had someone else that we need to get back to. Thanks, everyone. I still have questions in from Chris Treeguy. Daniel does things. I'm sorry, guys, we didn't get to your questions, but we will get those at the next show when everyone else is shy. Appreciate everyone being on. Remember, we are here live every Thursday at 4 p.m. Pacific time. Also, our self-directed IRA summit is April 17th. That is a full day talking about tax advantage accounts, self-directed retirement accounts, and how they can invest in private assets, whether that's real estate, a private fund, small business, crypto, precious metals. Your retirement account can invest in those assets. That's what we do at our company, Directed IRA, every day. We'd love to see you there. That is sdirasummit.com. Again, full day virtual training on self-directing your retirement account. Of course, we'll be back in next Thursday, 4 p.m. Pacific time. We'll see you then.